everyone. 2022 has been an incredibly humbling year for both Brian and I. I know that we have been our personal portfolios have been punched in the face, and we've made a lot of moves publicly that look ridiculously dumb with the benefit of hindsight. So we thought it would be useful for us to look back at some of the key painful lessons that have been seared into our brains during 2022. And we're also going to give you an update on our public portfolios that we have with Stock Card to show you how they have held up and lessons learned moving forward. And thank you to stockcard.io for sponsoring today's video. Brian, let's get right into it. We have 10 lessons here that we have queued up. There's probably more than that we could cover. But what is lesson number one that we learned in 2022?
Right. So lesson number one that we learned, and again, we'll review those portfolios at the end, is don't ignore the Fed. So the Fed sets the rates at which money can be borrowed. And as you can see, as those rates have climbed north, stocks, especially tech stocks, the NASDAQ's down 30%, and those are most assuredly related. That doesn't necessarily mean that I'm personally going to be changing the way that I go about investing until I get closer to retirement. And we'll get to that in lesson number 6.
Yeah, both you and I think, have largely ignored the macro in our investing careers. We've been focused on the micro, thinking so long as we find great companies to invest in, that they will overcome the macro in the long term. I think you and I are both bottom-up investors, and we've largely ignored the macro. 2022 has been the year when the macro has been the only thing that has mattered.
Yeah, absolutely. And it's worth saying that long-term investors, it feels bad now, but this really is just 1 year out of what can be. You've got 2047 above your head right now, many, many years. So that could prove to be a great, wise move on our part, but this is what it feels like to do that.
Yeah, for sure. Okay, point number two that we learned: inflation is not gone. We have seen a return of inflation for the first time in essentially 40 years. And Brian, I for one thought that the inflation had been licked. The reason that I thought that was I vividly remember in 2008 and 2009, there were big time calls for what? Get ready. Inflation is coming. You're going to see a surge of inflation over the next coming years, all due to all the government spending in 2008 to get us out of the Great Recession. And what followed was 10 years of the lowest inflation on record. 10 years is a long time to go when learning a lesson. So I, for one, was very surprised to see the return of inflation that we've seen this year.
Well, and the other thing I'll just add to that, Brian, is the fact that as the last 10 years have gone by, more and more of the things that we use are services like software. And it makes sense for inflation to stay low for software because it costs next to nothing to send code to someone to use. But what we've discovered is that physical goods do still matter in our world today. Energy, oil, housing, things that come through the supply chain, lumber, all of those things actually matter, not to mention wages for individuals. So it is a good reminder that it's not all digital right now.
Right. Inflation hasn't been licked permanently for the rest of our lives. And that's something that I learned the hard way this year. Okay, how about number three? Raise cash when making money looks effortless. And Brian, we had plenty of signs over the last 2 years that making money was essentially effortless. How is this for a sign? The IPO markets and what's going to happen next with investors' portfolios are inversely related. Look at 2020. 2020 was a record year for IPOs. And then look what happened in 2021. We saw double the amount of IPOs in 2021 that we saw in 2020. That is one surefire sign of excess that insiders are looking to cash out to bring their companies public. So that is certainly a sign of excess. Or how about this? Someone paid $1.3 million for a picture of a rock. I vividly remember myself in February of 2021, I went for a walk. My portfolio had just hit an all-time high by a wide margin, and I felt uneasy about that. I felt that making money feels effortless right now. However, what I failed to do was take that feeling of making money seem so easy, this can't continue, and I failed to turn that into a sizable cash position that I should have.
Well, and then just the other thing that I'll mention is there's two ways of looking at this. Companies raising money when this was happening was a really smart thing to do. I think of, for example, C Limited. They raised a ton of money, and it was because of that secondary offering that they had that the company is in such good shape right now
Mhm.
when things aren't going so well. But on an individual level, I think that what you said, you can raise cash by maybe trimming some positions. That's fine. That's not my style. But you can also do things like put money from your paycheck into your brokerage account and just decide, you know what, this month I'm not going to buy anything.
Right.
That's okay to do too.
Yeah, you can raise cash by investing less. You can raise cash by selling some of your extremely high-priced stocks. Looking backwards, that would have obviously been the right thing to do. However, I just know that for myself, the lesson I've learned is the next time making money feels effortless, I should be much more cautious moving forward, not worrying about missing additional upside, but focused on truly protecting the downside more so than I was.
All right. So let's move on to number 4, which is that crypto remains the Wild West. And look, if the last 6 months haven't taught us that, I'm not sure what will. Between Celsius, FTX, Voyager, the stories coming out of this industry shows that there's a lot going on that we don't know about that can harm us. And Brian, that is something that we've had to make tough calls about with this channel too.
Yeah. So I personally have put about 1%, less than 1%, less than 1% of my portfolio into crypto, mostly as a learning experiment for myself. But I've seen a lot of YouTube videos in the last couple of weeks about people taking down or calling out some of the biggest influencers in our space because of their relationship with FTX and BlockFi in particular, promoting those companies to our audience. We did not do that, but we were very tempted to do so. Many of those companies reached out to us and asked to advertise on our channel. I think that's one thing we did do right in over the last year is we said no to those products because we don't use them ourselves.
Yeah, and that sounds super easy sitting today where we do right now, but that was not easy to do at the time because it was a lot of money that people were offering for us to just mention their product. But again, it's not something that we use, and that's something, we're going to be punching ourselves in the face a ton during this video, but that's the one instance where we can give ourselves a little bit of a pat on the back.
Are you interested in moving crypto moving forward or crypto? I got yelled at this on Twitter, crypto or Bitcoin, because people think those are two distinct things.
I it right now, no, but it's one of those things where I am totally willing to put half a percentage of my portfolio in that
Mhm.
and lose that entirely, but never anything more than that. I did invest in it a while back and it went up a ton and it got to be too large a part of my portfolio. And I started following what Nassim Taleb was writing about Bitcoin and it convinced me to sell out at a very high price. That's not because of any skill on my side. That was just pure luck. But if I am, it'd be very, very small.
Yeah, I maintain a itsy bitsy position to crypto. I am happy to keep that. And I don't think that crypto or Bitcoin are dead because of this. They certainly have a black eye because of this, but it's still a reminder. It's still so early for that entire industry that it remains the Wild West and treat it as such.
Yeah.
Lesson number 5, cash is not trash. How many times did we hear big name fund managers or very popular people in the finance space essentially say these words, cash is trash? If 2022 has caught us anything, that is not the case.
Well, and Brian, here's the thing. You've got to understand the difference between a fund manager and an individual investor. Fund managers have to satisfy their investors every 90 days. So if the market keeps going up, they don't want to keep cash in the bank because it has the potential to make their returns look really bad once they hit that 90-day window. But if you're an individual investor, what cash does is it gives you options.
Mhm.
What kind of options? When the stock market crashes, you can go ahead and buy stocks on the cheap while other people don't have that cash around anymore. It's kind of like you just said, raising cash when the market goes up. It gives you that flexibility. So I don't think it's ever trash, especially if it gives you the opportunity to buy when no one else can.
That's right. The return you get from cash, even in a 0% world, which I don't think we're going back to anytime soon, is peace of mind. It's the ability to take a positive action after your portfolio has fallen, and it does help to reduce the overall volatility rate. So I have long believed, and I've long held a sizable cash position, even though mentally I counted that out. I was okay, this is going to lose money forever. But doing so, cash remains an important part of anybody's portfolio management strategy, especially as it relates to your personal finances moving forward.
All right,
Okay.
number 6. Bonds are, for the first time in a while, worth consideration. Now, it's worth saying that when we look at bond funds versus stock funds over the past year, they've pretty closely mirrored each other, but the returns, the yields that you can get on them are, for the first time, probably since 2007, looking somewhat attractive if that's your flavor of investing.
I have personally never owned any bond, zero bonds to my name. And if you look at what's happened this year, their returns have been just as poor. The total bond market is down essentially as much a year to date as the total stock market, which is quite remarkable thing to say. It's been one of the worst years on record for the 60/40 portfolio. Personally, here is my lifetime asset allocation strategy that I set up for myself a few years ago. And since I am still in the 10 years from drawdown, I consider drawdown to be quote unquote retirement, or when you actually need the money. Here is my asset allocation strategy prior to this year. I essentially wanted zero in bonds, absolutely nothing in bonds. However, if rates continue to rise, there is an argument to be made that they could get to a point that they're actually worth considering for a portfolio and returning to somewhat like a more normal allocation to bonds of let's just say I'm 40 years old, so historically, if you subtract 100 from that, that would be a 40% allocation. I don't think it's going to be anywhere close to that myself, but I could see myself putting 10, maybe even 20% of my capital into bonds at some point in the future because rates are becoming attractive finally.
And before we get to the next lesson, the one thing I want to say about this, Brian, is that we talked about the Fed, we talked about inflation, and those are things I'm not concerned about because 2046, 2047, that's when I'm going to need the money. And I think it's all a wash over that long of a time frame, the macro. However, if I were close to retirement or when I get closer to needing that money, then I'm going to pay a lot more attention to the Fed. I'm going to pay a
Mm,
lot more attention to inflation. I'm going to be a lot more careful about that. That's one of the advantages that we have being in our early 40s. But as we get closer, or if you right now are closer, then yes, those things probably do matter more.
mm. Okay, well said. Okay, number 7. Owning growth stocks is harder than you can imagine. Boy, has owning growth stocks been fun over the last 12-ish years. Owning growth stocks over the last 18 months has been absolute agony. Look at the returns on just some of the popular stocks that we've covered on this channel, some of which we own, by the way: Peloton, Affirm, Asana, DocuSign. DocuSign really hurts me. That was one of my top 5 positions at one point. Shopify, I know that was your number 1 for a
Yeah, it was
while,
my number
Brian.
one for a long time.
That was your number 1. I own Twilio. I own Block. You've been really bullish on Cloudflare. We both own that one together. I own Zoom. I own Zilla. And these have been gut-wrenching downturns, just gut-wrenching downturns. Moreover, if you look at the NASDAQ when compared to the Dow and the S&P 500, the NASDAQ has been absolutely clobbered this year. Owning growth stocks has been brutal over the last 18 months, maybe even getting close to 2 years now. So if you are going to own these stocks, which I still do and I still want to own for the long term, you have to be mentally able to withstand these enormous drawdowns, which is so hard.
This is the price that you pay. This is why investing in these stocks has such high returns. If this didn't exist, if the last 18 months didn't exist, then there's no way that the stocks that we typically invest in could have such good returns over the long run. This is the price of admission to investing in growth stocks, and it stinks because look, if you're down 90%, then that position has to 10x to get back to where you were.
Mm-hmm.
That's a tall order.
It is a tall order for sure. So it's extremely painful. Here's an interesting one. I credit Jim O'Shaughnessy for highlighting this, and I so agree with it. Narrative follows price. Price does not follow narrative. Narrative follows price. What do we mean by that? consider the 18 months that Upstart has had. Upstart went through in 2021, 10x in 1 year. 10x in 1 year. People were calling it a revolutionary new credit system. What's happened Upstart over the last year? It's down 95% from that peak. And what is the narrative today? This company is utterly worthless. It doesn't work. This is a textbook case of narrative following price, not price following narrative.
Right. And the key is making sure that you don't fall for that on the way up, so you don't fall for it on the way down too. And what I mean by that is the nuts and bolts of how Upstart's technology works hasn't changed. It's the same, it's probably evolved somewhat, but the nuts and bolts are the same today as they were a year and a half ago. The way that the market wants to value that is what has really changed. And so the same thing is going to be true now. The stocks that we are totally dumping on, that the narrative is totally dumping on, is going to switch to be euphoric at some point, and we have no idea when that is. And the goal is to never get too high or too low in the narrative you're telling yourself about those stocks.
Great. Number 9, and we knew this ahead of time, but man, 2022 been the year that really proved this. We suck at timing the market. We absolutely suck at timing the market. Here is the NASDAQ over the last 3 years. And we just want to point out.
Yeah, let me take this one. So give you some points. The first one, I went on record on Twitter saying that this was the suckerest of all rallies. This was not it. That was in March 2020. And the stock market did nothing but go up. And it's still up significantly from that point. I was totally wrong.
Or how about this? How about us launching this YouTube channel focused on teaching people how to analyze individual stocks and talk about essentially a lot of growth stocks? We started this channel in May of 2021, which was close to the peak, pretty close to the peak.
Yep. How about this? I went on a YouTube channel to talk about how at that point in time, my portfolio had 10x'd over the past 10 years. And that's true. I wasn't embellishing. It had 10x'd over the past 10 years. It's down about 50% since then.
How about this? I launched my book called Why Does the Stock Market Go Up in April of this year. And what has the stock market done pretty much since I launched my book? Go straight down. Now, I didn't call the book The Market Always Goes Up. I called it Why Does the Stock Market Go Up? But the reception to my book, I'm sure, would have been very different if it launched in April of 2020 versus April of 2022.
Our timing sucks. All right, which all brings us to number 10, which is that, look, investing is hard. Investing is hard, and it's hard because it can seem really easy for a long time. And you're like, I'm going to keep doing what I did when it was easy. And then all of a sudden it's not easy. It's really, really hard. And pretty much anything that you could throw your money behind has been down lately.
How many times this year have we seen this? Just an absolute red day across the board. You open up your portfolio, you're down 3, 4, 5, 6, 8%, even more. We have seen some absolutely torturous day on the way down. Investing is hard. It's supposed to be hard because if it was easy, everybody would do it. But investing is really, really hard. And this cycle of market emotions, there is so much truth to this simple graphic, right? On the way up, people are optimistic, excited, thrilled, euphoria. And on the way down, boy, is it painful. And dealing with the roller coaster ride, this cycle of emotions, that is something that's easy to do in theory. It is an entirely different thing to do when you are living through it minute by minute, day by day, when you are consuming news item after news item, when you are seeing negative headline after negative headline. It just wears on you like nothing else.
And Brian, here's the hardest part about it. In hindsight, we can always see where we were in that cycle at a specific time. We can say, oh, we were at this point on March 9th, 2009, when the market bottomed. That was despondency. You cannot know where you are in that cycle as you're going through it. Life always makes sense looking backwards. Unfortunately, we have to live it moving forwards, and it will never make sense until we reach some future point and look back.
Case in point, where are we right now?
I have no idea. Anywhere from desperation to depression. I have no idea.
Right. Are we, is there another 10% down, 20% down, 30% down, 40% down? I don't know. Are we at the despondency stage right now? It's all up from here. I don't know. But living through the cycle of market emotions in real time and experiencing these emotions in real time and wanting to pull your hair out, wanting to sell everything in real time, it is damn hard to deal with these emotions as we go through as investors.
All
So
right.
we would love to hear what lessons you learned along the way. Please let us know in the comment section. We're going to highlight some in just a little bit. But what we want to do now is transition to reviewing, as painful as it's going to be, how our public portfolios that we held on Stock Card have done over the last year, and see if we can glean any more lessons, see what companies we have been quote unquote right about and what companies we have been quote unquote way wrong about moving forward. As a reminder, each of us has 2 portfolios on here. We both have a thumbs up portfolio that meet our investing criteria, and we also have a thumbs down portfolio, those that did not meet our investing criteria. So we have some data to share on how picks have done in each.
That's right. So let's go over yours first.
Sure. So we rated, of the stocks that we rated, so those that were in my 69 or below category have returned a net negative 38% versus the S&P 500. Those in my investable category, so those are in the slight thumbs up, have returned negative 30%. So outperformance, although you can't eat that relative return, right? And then my high quality businesses have returned negative 32%. So it does seem that after a year and a half we've been doing this, there is some separation between those companies that I did not like and those that I liked more.
Yep. And a similar-ish story when we look at mine. Those companies that scored very poorly are losing to the market by 34%. That middle area, there was a lot of companies that ended up in there that I personally did not invest in, but it did even worse, negative 39%. But the one that did the best was the anti-fragile category, but none of those are worth writing home about. So let's dive into those. But Brian, I think we really need to hammer this home, because we said this when times were good as well. We said this between when we started this project with Stock Card and November 2021, when things really started falling, that none of our outperformance is indicative of a conclusion. Our underperformance, it hasn't been long enough to know which lessons are worth learning. We've always said 3 to 5 year time frame, and I still believe that. However, it is educational to go back and look over what we've said.
Certainly is. And by the way, this is one of the key reasons we partner with Stock Card.
Absolutely.
We were looking for a public tracking tool for ourselves, a public tracking tool, and we think that this has been an excellent one. So, okay, we're going to start with the anti-fragile portfolio. This is Brian's thumbs up, right? These are the ones that passed a score of 7 or higher. So let's start with the biggest losers, shall we? So the biggest users that you gave the thumbs up to, Affirm, buy now, pay later, has been absolutely decimated since we did that, down 90%. Now, Peloton,
one thing I'll say about Peloton real quick is that ended up there, and I bought it personally, and very shortly thereafter, we did some more digging into it, and we did a video on how I was selling. So while that one's in there, it is one that probably within about 6 weeks changed our minds on completely.
Right. I never entered that in my portfolio. I did give it the thumbs up, I'm pretty sure, in mine. But man, Peloton, I personally caught the Peloton. When Peloton first came public, I was skeptical. I didn't like the hardware model. Their execution was stellar for a short period of time. But in the end, the business model won out.
Well, and the execution, it stumbled quite a bit too.
Yep. Clover, I'm surprised that one got a thumbs up from you.
I mean, I think that in the end, I probably was just more generous with the moat than I should have been. Just more generous with the moat than I should have been.
Okay. GoodRx, that one's down 88%. That's one that I own in real life. That company, that to me is a great example of a company with concentration. concentration issues.
Kroger.
What one of their customers, Kroger, made a single decision, and that single decision has essentially upended a huge amount of that. Because
Yep.
on the surface, lots to like about GoodRx, good brand, strong growth, lots of optionality, founder-led, profitable, free cash flow positive. That's a company I was very, very interested in. So much so that I bought a position in it myself. And man, oh man, has that proven to be a horrible investment.
And to actually hammer home that point, there was one very minor change that I've made in my framework because of a situation like that, which is it's not just concentration that can get points off anymore for me, because Kroger wouldn't necessarily, they aren't an end customer, right? They are in the value chain. And if they make a change, it changes the business results, so that now I call it a single point of failure instead of concentration risk, because if that single thing changes, it can throw a business totally out of whack.
Yeah, I think both of us have slight changes to our checklist coming in the next couple of weeks. So maybe we should do a video about that, or a live stream with that, about how we're talking about that. But yeah, you made that that one change. All right, moving on. Redfin. That's been a disaster of a story there. The home flipping business there just did not work out.
Yep.
I didn't get burned by Redfin personally, but I own Zillow, and they've had very similar results. Roku has been one that I own. That's been awful. Fiverr, another one I own, has been down. So lots and lots of companies on here have been hit hard. But
Coinbase, I'll just also say, is another one where that single point of failure risk we didn't mark any points off for it. But if we reviewed it today, we absolutely would, because the price of Bitcoin is absolutely a single point of failure. Like if anything happens with that price of Bitcoin, then Coinbase is going.
I personally don't understand why you would invest in Coinbase ever. If to me, a bet on Coinbase is a bet on Bitcoin. And if you're going to bet on Bitcoin,
just bet on Bitcoin.
Bet on Bitcoin. Personally, on the flip side, a big winner has been Enphase. Enphase Energy. I think this is because anything energy has won, but Enphase was a higher quality company than both you and I thought when we first did it. Very surprising. Another one in the green, Novacure, which, by the way, is a company we bought for our public portfolio. And this is the one we got the most question marks and the most hate for.
Yes, we did, by far.
Buying Novacure. People thought it was a money-losing biotech, or they committed, and it does have FDA risk for sure. But this is one of the winners in the portfolio. Coupang, I'm not going to call victory on in any way, because it was down from the high, and then we checked out it again. Axon is in the positive, Brian.
Now, and I'm gonna toot my horn a little bit, because this has always been one of my highest conviction holdings, and it remains so today. Yeah.
Right. All right. I think that's enough of beating up on this one. The net return there is a big negative number, and a big loser to the S&P. My turn to go through some pain, and we're going to see a lot of similar results there. The biggest winners were Enphase, Novacure. This one is interesting. Starbucks, Brian.
Yes.
Because this is one that we disagree on.
We did. And this is one where I'm okay throwing out good companies as long as the ones that score 12 and higher end up being great investments. This is an example of that.
Yep. This is you were not interested in Starbucks. Starbucks is one of my bigger holdings in there. Held up very well for a bunch of reasons. Okay, but let's go to my biggest losers, because we've had a bunch of them. So yep, Peloton in there, GoodRx in there, Roku in there, Fiverr in there, Coinbase. So I did give the thumbs up to Coinbase. Boy, was that a mistake, because I should have. This would be a limitation of my checklist, because like you, I did think at the time. Oh, by the way, when we reviewed it, don't forget Coinbase, profitable.
Yeah.
Very, very profitable. Like crazy margins. And they came public at the right time. We reviewed them when crypto prices were booming, but a bet on Coinbase was a bet on crypto. That should not have entered my thumbs up. So that was a limitation of my checklist. So my scoring system there on that one was obviously completely flawed. C Limited has been very disappointing, because that was one that checked a lot of boxes for both of us.
Yeah, I think the thing with C Limited is that they overextended themselves to focus on things where they weren't going to have a moat, and they spent a lot of money doing that, and that is the real disappointing thing there.
Right. UiPath. Wow, UiPath is down 80%. That to me is a lot of valuation, because from what we've seen out of that company, the execution has been pretty good.
Yes, it has.
Yep. D local is not one we've looked at much recently. Shopify has been a huge disappointment for both of us, but a lot of similar companies on there. Palantir got my thumbs up, so that must have been right on the border.
Yeah.
Because the Palantir to me is a company with a moat that I'm interested in following, but the stock-based compensation there is just egregious, just absolutely egregious. So interesting to see that I had the thumbs up to Palantir. Atlassian, that one's been a painful to watch because that is like a very high quality company.
Yeah. Absolutely. It's one of the highest quality companies I think that we've gone over, and that's down 67%. I'll say that we did review it just before the market started falling 2 months later.
Right. Wow, Yeti got my thumbs up. That is surprising. That is surprising when looking backwards. So yep, a lot of pain here. Okay, let's try our thumbs down portfolio. So this is the ones that we passed on. So for here, a positive score would mean we got that wrong.
Right. And so I'll just say that the big one here by far is Celsius. Celsius has executed flawlessly.
So
They're an
well.
energy drink company. They've done amazing. This is what I mean when I say we can throw things out that are good. That's okay with me. And we've correctly put some of the worst. And if you go to the other end of this, you'll see companies that are down big, and I don't expect to go up anytime soon, like Context Logic, like App Harvest.
We'll check those, but yeah, to your point. So the biggest surprises here have been Celsius, which has performed very well, just great execution. Even though we didn't think that company had much of a moat, still don't think that, by the way.
Right.
But great execution. Digital Turbine is another one that I was negative on, and that one has performed very well. But yeah, let's get to the ugly side of things. App Harvest is one that we both thumbs down to.
Yep.
And that's been a money eviscerator. Wish, Context Logic, another one that both of us, when we reviewed it, were like, I don't like this company at all.
I hate it. Moving on, Fubo, like I don't see any moat there. AMC, Teladoc was one that a lot of people were surprised we were negative about.
Yep.
But not for me. I don't see a moat there.
Yeah, Teladoc. I like healthcare and I like technology. So in theory, Teladoc would be right on the cusp of both for me. The thing I never liked about Teladoc was if the company was so great, why was it acquiring so much of its growth? Why was it acquisition? That is a strategy that's very hard, very hard to pull off. SoFi has been that company has performed much better than the stock price would indicate. Sure. Jumia, another one that we got some pushback for because in the theory, the headline is the Amazon of Africa. Sounds great.
Who wouldn't love that?
Right. And then you get digging the details and you're like, is this the Amazon of Africa? Yeah. This seems to be interesting company in name only, but below the surface, lots of ugliness there.
Yep.
Chewy's an interesting one. Celsius. But yeah, to me, Celsius is the one that I would say surprised me the most with how well it's performed, just how well it's executed. And let's go to my painful one. These are the companies that I gave the thumbs down to. I think I got the same ones wrong that you did, which would be Celsius, Digital Turbine, Unity, but this was just recently. This was just recently that I did that wrong. StoneCo has held up really well. This is actually super surprising.
That is very surprising.
Brazilian payment processor, which is essentially flat since we did, although that was just earlier this year. So that's why. Boston Omaha was one that was quite complex. Lemonade's been down big time on there. And again, this is my thumbs down. So yeah, the ones that I guess are the calls here that I guess I'm saying, yeah, I still feel this way. Context Logic, Affirm, Fubo. Lots of people are interested in Fubo.
Yeah.
And that was a company with a negative gross margin at the time. Anything else really stick out to you?
No, not really. I mean, I think so. I think just to kind of wrap it up, the thing to say here is, look, the most important thing to us is to be as transparent as possible because, Ogie, you're right. This is a postmortem, but also to remember that this isn't actually a postmortem. you and I, we're not selling our portfolios and calling it quits on market investing. We are talking about being as clear as possible with what we are doing, telling you why we're doing it, and then holding ourselves accountable. Are these the lessons that you should take away? I'm still not convinced yet. I still think you need to wait 3 to 5 years. And I'm not going to move that timeline either. We started in 2021. Our average picks, let's call it January 2022. So 2025 to 2027, that's when you can look at this and look, go back to StockCard and you can follow us there to see how that evolves over time. Brian, are you considering your sequel now?
Yeah. Yeah. See how many times this joke has been made about a sequel to my book called Why Does the Stock Market Go Down? Yeah, I should just call it Why Does the Stock Market Go Down? Would have been a bestseller.
Well, if you start writing it now, then we'll know when the bottom is.
Exactly.
And
by
then,
the time it's
we'll
ready,
help
the
everybody.
bottom will be here.
Mhm.
I should do the world a favor right now. Here's a question from Tutorials Highs. Do you guys actually buy growth stocks right now? I'm not talking about your $250 challenge. I'm talking about your own money.
I have not, but the end of the year is coming up, and I do have some plans to do some consolidating, some selling off lower conviction stocks, some buying higher conviction stocks. That's one of those things that we have to do that, like, because of our work for the Motley Fool, we've got to plan out a little bit more.
Yep, it's a little bit of timing on there. But when we say we are making those public investments, that's because we believe in that company at that time.
Yep.
And since we've started doing that, the trend has been this. Right.
Yep.
We are swimming against a massive tide. But when we say we're buying those companies, it is because we like that company right then and there for the next 3 to 5 years plus. And oh, by the way, we expect to be wrong 60% of the time. But if we're right on just a handful of them, we expect the entire portfolio to outperform. That's how investing works.
Yep, absolutely. And it only works that way if you give it time, because those 1 or 2 stocks are going to pull it up. You have to wait a really long time for them to do that.
Yeah. Such a good lesson from Hoda saying when money looks effortless. Thank you. Thank you, Hoda. See anything else on there? Did you guys survive Rapture with the black eyes? Yeah, I had fun with that thumbnail. Hope you guys enjoyed it.
That was some of your finest artistic work.
Right. Okay. Well, thank you guys so much for watching this. We really appreciate it. 2022 has been a very painful year for us. We have no idea what's coming in 2023, but my personal plan is the same. Continue to put money into the market, continue to buy the highest quality stocks that I can find, continue to own them with a long-term mindset, start to watch the macro, start to think about that moreover. But that is my plan. And I'm sure I'm going to learn lots of lessons next year too, but probably not as many as we learned in 2022.
That's right. And I just want to encourage folks, if you get the chance, head on over to StockCard, go to the Portfolio Center, and you do still have time to enter our Beat the Bryans contest. And look, you could still beat us. There's only 1 month left. Right. But if you have the highest returns over the whole year, over that 1 month, then you win $1,000. So
right, if you just pick cash, you'll probably you'll crush us. Yeah. Thank you so much to StockCard for sponsoring today's video. Links to all of those portfolios that we have are in the video description below, and we will do an end of year review again to let people know who won the contest. The Beat the Bryans contest has been going this whole time. Thank you all so much for watching. See you in the next video. Brian.